Hello everyone. In this video I'm going to go through the Topic 9 Risk and Return Notes for BU 381. So in these notes we're going to start with the second part of this. We're going to start by talking about the return, and that's actually pretty the shorter part of this, and then we're going to talk about risk and how we measure risk and how we can calculate the measurements for risk. So to start off with the returns, the return on an investment is your gain or loss on an investment. Returns measure the financial results of an investment, and returns can be expressed in dollar returns, so they'll be in dollar amounts, or percentage returns or percentages, or sometimes we just use decimals. So dollar returns for stocks consist of the income from dividends and the capital gain or loss. So the dollar return is equal to the dividend income plus the capital gain and loss for the stock. So for example, if you purchased Apple Computer stock on April 18th, 2018 for $177.84 per share, received $2.92 in dividends for the next year, and then sold your stock 1 year later for $203.13, your dollar return would be equal to the dividend of $2.92 and the capital gain, which is going to be what we sold it for, $203.13, minus what we bought it for, which was $177.84. So our capital gain is equal to 203.13 minus 177.84, or $25.29. So our total dollar return is going to be the $292 plus the $25.29, or $28.21. So again, our total return is equal to our dividend plus our capital gain. So our total dollar return is $28.21 for this stock. Oftentimes though, when we talk about stock returns or returns on other securities such as debts or real estate or things like that, we're usually talking about percentage returns. So just like dollar returns, percentage returns come from capital gains and income, and the income is dividends for stocks. So the dividend yield is equal to the dividend for time t plus 1, so for the next year after we purchase the stock, divided by the initial stock price. So if we calculate the dividend yield for Apple, that would have been the $2.92 for our dividend, $2.92, divided what we initially paid for the stock of $177.84. So the dividend for our year, and I apologize, that's a 2, is equal to $2.92 divided by 177.84, or 1.64%. The capital gains yield is going to be the price at the end of the year minus the original price divided by the original price. So for Apple, again, we're going to take 203.13 minus what we originally paid of 177.84 divided by the original price of 177.84. And so that gives us a capital gains yield of 14.22%. So the total percentage return is equal to the dividend yield plus the capital gains yield. So we're going to add those two together, and that's our total return for the year. So our total return is 15.86%. So the dividend yield is 1.64%, the capital gains yield is 14.22%, and our total percentage return for Apple for the year is 15.86%. So the historical record, and I'm just going to show you one example of the different securities we're talking about, but historically, small capitalization stocks, so what this means are these are small companies. Capitalization means market capitalization, or the total equity value, market value of equity for the firm. So small capitalization stocks are companies that aren't very large. And so small capitalization stocks historically earn higher returns, and I apologize, that should say than, not that, than large capitalization stocks. And let me just show you an example of this. We go out here. This is a graph on an article by the Motley Fool, and it shows the S&P 600 versus the S&P 500. The S&P 500 is an index of the 500 largest stocks by market capitalization. So the top stocks in this index right now, they alternate between these three companies, but Apple, Amazon, and Microsoft tend to be the largest companies in the S&P 500 right now, but they're very big companies. So it's the 500 largest companies, and then we have the S&P 400, which isn't represented here, and those are the mid-cap stocks. So they're smaller. They're the companies in the S&P 400 mid-cap are smaller than the S&P 500, but larger than the S&P 600. So together they make up what's called the S&P 1500. The 1500 are the largest stocks, the 1500 largest stocks by capitalization, by market capitalization, traded on U.S. exchanges. So they are all kind of large stocks, but because there's 1500 of them, the small cap stocks are quite a bit smaller than the large cap stocks. And so what we can see here, so think of this orange line here as the return for an index of smaller companies, and the blue line as the returns for an index, of large companies. And we can see here that with the exception of this period of about 1995 through 2001, the small cap stocks, the small cap stocks outperformed in terms of percentage returns the large cap stocks. And if we look over longer periods of history, this holds true. Small cap stocks tend to outperform large cap stocks. So why is this? Well, large cap stocks or large companies are less risky than small companies. Large companies are less risky than small companies. And you might ask yourself why. There's a number of reasons why large companies are less risky than small companies. One, you might have heard the term too big to fail. At a certain size, society and specifically our government won't allow a company to fail. We've seen this several times. General Motors in 2008, the U.S. government stepped in, purchased the majority of the equity in General Motors to keep it from failing. In 2009, 2008, 2009, the U.S. government stepped in to keep very large banks from failing and started bailing them out and paying and essentially making sure that they could survive. Because if they would have crashed, if they would have fallen, or if they would have gone into bankruptcy, it would have hurt a large portion of the U.S. economy and U.S. society. So some firms just get to be too big to fail, and so they're less risky because you've got the government there backing them up. Another reason is that large companies have better access to capital markets. If a very large company needs to go out and borrow money, there's many places they can go. They can go out and issue commercial paper in those markets. They can issue bonds fairly easily. They can go to banks and get loans. Smaller companies don't have access to all those markets. So a fairly small company may not be able to issue commercial paper because that's really reserved for the largest and safest companies. They may not have the ability to go out and issue bonds as easily as a large company, and banks might consider them too risky to lend to. So they have better access to capital markets. And finally, larger companies tend to be older. They've been around for a while. They're not new startups that have a lot of risk to them. So they're more well known and generally less risky. An exception to this might be Amazon. It's been around for a while, but not a very long time. Tesla is a fairly large company in terms of market cap, but it's not been around for a long time. But in general, large companies are less risky than small companies. Here's three reasons why too big to fail have better access to capital markets, and large companies tend to be older and have a longer history. As a result, small companies earn higher returns, and those are required by the investors for taking on that additional level of risk. Stocks or equities in general earn higher returns than bonds because they're riskier. And we've talked about this before in here, but bondholders have a priority to the income and assets of the firm, meaning that bondholders get their interest payments first before stockholders receive dividends. And in liquidation, if the company goes bankrupt and is liquidated, bondholders get paid off first before stockholders get anything. So as a result, for any given company, the stockholders take on more risk than the bondholders because the bondholders get paid first. So as a result, stockholders require a higher rate of return, or an expected higher rate of return, I should say, than bondholders are receiving. Corporate bonds earn higher returns than government bonds, and again, it's risk. Corporate bonds are riskier. And when I talk about government bonds, I'm talking about U.S. government bonds. If we talk about bonds in Venezuela, government bonds are very, very risky. But in the United States, corporate bonds are riskier than government bonds because the government can raise taxes and print money to pay its debts. Amazon, no matter how powerful and profitable it is, still Jeff Bezos cannot print money. He can't go over to the Washington Post that he owns and start up the printing presses and start getting cash out of it. He could, but he'd go to jail for that. It's illegal. The government can do that, though, although it would cause inflation. But people that buy government bonds know that the U.S. government, will be able to pay them back, and so they require a lower return than investors in corporate bonds would require. Finally, long-term government bonds provide higher returns than short-term bonds, and let me put in here usually. When the yield curve is normal, this is true. When the yield curve is inverted, as it has been lately, this isn't true. But the question is, why is this usually true? It's because long-term bonds are riskier. If you think back to when we talked about interest rate risk, the longer the time to the maturity for a bond, the greater the risk that a change in the interest rate would have an effect on the change in the price of the bond. So because of interest rate risk, long-term bonds generally provide higher returns than short-term bonds. So overall, we've gone through 4 different types of investments and compared 2 types of investments, either large stocks and small stocks, stocks and bonds, corporate bonds and government bonds, long-term government bonds to short-term government bonds. The returns earned by different investments are based on the level of risk of that investment. And I should say that is over the long-term period. So the stock market might take a hit this year, might go down. And in that case, the returns on stocks might be lower for a short period than bonds. But in the long term, bonds provide a higher return because they have a greater level of risk. People want to be compensated for taking on risk, and so those securities in the long run have to provide higher returns. So risk premiums, a risk premium is the excess return required from an investment in a risky asset over that required from a risk-free investment. Oftentimes we'll use U.S. Treasuries as our risk-free investment because they are free of default risk and liquidity risk. And just as a reminder of what those are, default risk is the risk that the company won't pay as agreed. And liquidity risk is the risk that nobody will be there that will be willing to purchase your investment at its market value in a short period of time. So that neither of those are true for U.S. Treasuries. U.S. Treasuries are, again, considered to be default risk-free, and there's always a willing buyer whenever you go to sell those bonds. So what determines the risk for premiums for different investment types? And again, that's going to be the level of risk of that investment type. All right, so that kind of finishes up our return discussion. What is a return? What are risk premiums? Why do some securities earn higher returns than other ones? And now we're going to get into the risk side of it. So in this lecture, what I focus on is expected return in the future and expected risk. and it's based on the calculations we're going to do are based on historical returns during different types of the economy for different securities or different stocks. So the formula for calculating expected returns is ER, so that means expected return, just the R itself means return, is equal to the sum of the return in I is a specific state of the economy, multiplied by that state of the economy occurring. The formula for calculating the variance of expected returns is the variance of expected returns is equal to the sum of the expected return in a specific state of the economy minus the expected return overall. Then we square that and multiply it by the probability. We take all of these different ones for all the different states of the economy and add them together, and that gives us our variance. The formula for the standard deviation of expected returns, so this is sigma, small sigma, which is how we denote standard deviation of the expected returns, is the square root of the variance. That might seem a little complicated. We're going to work through a few examples of this. So make sure you've got your calculator out, and we're going to look at two different companies here. And these examples are about 3 years old. I made these up about 3 years ago. So if you look up these numbers today, they might be a little bit different. The way that I calculated these is that I looked for about a 15-year period of time at the returns during different states of the economy. So overall, and this is an estimate here, the probability of a recession is about 15% in a given year. The probability of a normal economy is about 70%, and the probability of a boom is about 15%. And I calculated this recession based on the probability, or excuse me, the number of times in a long historic period that there was a recession during a year. And what that means is that there's 2 quarterly periods of GDP decline. And then, so that what I've told you is the economic definition of a recession. It's what our government uses, 2 periods of GDP decline. There's not a definition of a boom. So what I used is, I believe, and it might be a little bit off here, is 4% increase in GDP growth, but that might not be quite right. I basically made it so the probabilities between these two would be the same. So for those time periods that met these definitions, I calculated the return for the stock. So in this case, it's Tiffany. Tiffany is a luxury company. They're known for selling diamonds. And other very expensive things. All right. And so for the years when there was a recession, the return on the stock for Tiffany was negative 28.52% on average. During the normal economies, the return on average was 22.81%. And then when the economy did really, really well, so did Tiffany, 99.79% return during those years. So if you think the economy is going to boom and it's just going to explode and grow, Tiffany is a good option to consider looking into for an investment during those time periods. If you think we're going to go into a recession, then Tiffany would not be a good option. So the way we calculate the expected return is we multiply the items in column 1 by the items in column 2, and then we're going to find the sum of those. So in this case, I'm going to use my calculator, and I'm going to take 0.15 multiplied by negative 0.2852, and so you can see here I'm changing this over to a decimal, and I get negative 0.04278. I take 0.7 multiplied by 22.81, and I get a value of 0.1597. And then finally, I'm going to take 0.15 multiplied by pretty much 100%, but I'll put in 0.9979. And that gives me a value of 0.1497. So my expected return is the sum of these individual numbers. And so the idea here is that I don't know what next year's going to bring. It could be a recession, it could be a normal economy, it could be a boom. So I'm applying the probabilities of those occurring to the different returns that we expect to occur during those types of the economy to get the expected return for any given year. So now I'm going to add all those together. Negative 0.04278 plus 0.1597 plus 0.1497 gives me an amount of 26.66%. So my expected return is 0.2666 or 26.66%. Okay. So in the next column here, we're going to calculate the deviation from the expected return. What I'm going to do for each one of these is I'm going to put the number in here, calculate this one, and then finally calculate the final one. It's just easier to do them one at a time because you're going to use the same numbers. So to get the deviation from the expected return, I'm going to take the rate of return if that state occurs, 2, so you can see up here 2, minus the ER, the expected return of 0.2666. That's going to give me my deviation. Then I'm going to square that deviation, and then I'm going to multiply that squared deviation by the probability of 15%. So I'm going to take negative 0.2852 minus 0.2666. That gives me a deviation of 0.5518, negative 0.5518. I'm going to square this deviation. So I press the x squared button on my calculator, and that gives me 0.3045. And then I'm going to multiply that squared deviation by the probability of 0.15 to give me 0.04567 or 0.0457. So let me explain why we do these things. So we're interested in the volatility of the stock. In the end, that's what we're measuring through the standard deviation. So we take the expected rate of return for the individual state of the economy here, and we find the deviation between that return and the expected return overall, and that deviation is negative 0.5518, or the absolute value of that is 0.5518. It's a fairly large deviation from the expected return. In order to focus on the size of the deviation and not the sign of the deviation, we square it, because squaring a negative number makes it positive. Squaring a positive number makes it, or keeps it positive, because what we're interested in the standard deviation is not the direction of the deviation, negative or positive, but actually the size of the deviation. How much variation do we have in stock returns? So we square it to get the square deviation. We multiply it by the probability, and then you're going to see when we find the standard deviation, so we squared it, and then we're going to find the square root of it. The purpose of squaring it again is to take it from a negative value to a positive value if it is originally a negative value, and then we bring it back down by taking the square root. So I'm going to finish this up. I'm going to take the 22.81 minus my expected return of 0.2666. So my deviation is equal to negative 0.0385 I'm going to square that to get a really small number, 0.0015. And then I'm going to multiply that by the probability of 0.7. And I get 0.0010. For the last one, I'm going to take my really large return here of 99.79, so 0.9979, minus my expected return of 0.2666, gives me a value of 0.7313. I'm going to square that number to give me 0.5348. And then I'm going to multiply that by the probability of 0.15 to give me 0.0802. What I'm going to do now is I'm going to add all these up. I'm going to find the sum of these, and the sum of these three numbers will be the variance. So my variance is 0.1269, and then I'm going to take the square root of that number to get the standard deviation of 0.3562, or 35.62%. So that's quite a large standard deviation. But it makes sense because of the range of my outcomes here. So the range of my possible outcomes for Tiffany is almost 130%, depending on the state of the economy. So that's going to give us a fairly large standard deviation. So let's go through and work through the family dollar values. I'm just going to sit here and work through them. I'll talk a little bit so everything doesn't seem so quiet. I'm just going to do everything like I did before, but what you're going to find here is that the standard deviation is going to be much smaller, because look at the range here. The range is, in a normal economy, the return is 27.37%, and in a boom it's negative 1.38%. In a recession, family dollar does okay, and so our range is really about 26%, or I'm sorry, 28%, between the two. Or I'm sorry, closer to 29%. This almost 130%, this 29% range. So we should have a smaller standard deviation. So I'm going to calculate the expected return by multiplying these and then finding the sum. So I'm going to take 0.15 multiplied by 0.2077, gives me 0.0311 or 12. 0.7 multiplied by 0.2737 gives me 0.1916. And then finally 0.15 multiplied by negative 1.38% gives me a value of negative 0.0021. So now we can just sum these together, and that's going to give us our expected return. 0.0312 plus 0.1916 minus 0.0021 give us an expected return of 0.2207. or 22.07%. So now I'm just going to go through and complete these. The deviation from the expected return is 0.2077 minus 0.2207, or negative 0.013%, excuse me, negative 0.013 or negative 1.3%. I'm going to square that deviation to get a really small number. This really small number is 0.0002. Or if you want to get very specific, it's 0.000169, but we'll round to that fourth decimal. And then I'm going to multiply that by the probability, which is going to make it even smaller. So 4 zeros and a 3. 0.00003. Okay. For the normal economy, my deviation is going to be 0.2737 minus 0.2207. Gives me a value of 0.053. I'm going to square that deviation to get 0.0028. And then we're going to multiply that by the probability of 0.7 to give me a value of 0.002. So it's 0.00196, and I just ran that up to 0.0020. The last one is also going to be fairly small. I'm going to take my negative 1.38, or actually it's going to be fairly large. Negative 0.0138 minus 0.2207 gives me a deviation of negative 0.2345. I'm going to square that deviation to give me 0.055. And again, what I'm just rounding this 0.05499 to 0.0550, and then I'm going to multiply that by 0.15 because that's the probability again, to give me 0.0082. Now I'm going to add these all up. 0.12343 plus 0.002 plus 0.0082, and that gives me a value of 0.01023. The square root of that number gives me a value of 10.11%, 0.1011 or 10.11%. So we can see here, so here's my math on my calculator. We can see here that the standard deviation of these two different stocks is very different. The returns aren't terribly different. You get a little bit higher expected return with Tiffany than you do for Family Dollar. The returns are very different because the range of outcomes for Family Dollar is fairly low. If we were to categorize these companies, Tiffany, like I said, is a luxury. They sell a lot of diamonds and other very expensive things. Family Dollar does not sell expensive things. They are a discount retailer. They sell consumer staples, so the stuff we just kind of use it day in, day out. They sell consumer staples at a discount price. So Tiffany is considered a pro-cyclical company, or a cyclical company. So Tiffany is a cyclical company. The company does well when the economy does well. The company does not do well when the economy does not do well. Family Dollar is not a secular company. We might consider it to be a little counter-cyclical because they don't do well when the economy does well. To truly be counter-cyclical, we would expect the return during the recessionary times to be higher than the normal, and then the normal to be higher than the boom, but it's pretty close here. So Family Dollar is somewhere between a non-cyclical and a counter-cyclical company. Probably closer to counter-cyclical because of this. So why is that? Why are these things happening? So I'm just going to put down here Family Dollar is somewhere between counter-cyclical. In other words, it moves opposite of the economy, or non-cyclical. For it to be truly non-cyclical, sorry about that, to truly be non-cyclical, we wouldn't expect any interaction or any relationship between the state of the economy and the returns for the firm. So for Tiffany, why is it a cyclical company? Well, when people have more money, they buy more luxury items. So when the economy is doing well, they buy more luxury items. Okay. When the economy is doing poorly, they're not going to Tiffany, they're going to Jared, or I think it's K Jewelers. Every kiss begins with K, except for during a boom economy, and then, you know, if you're lucky, you're going to Tiffany. With Family Dollar, if you're doing really, really well and you got money coming in, you're probably not shopping there. Okay. Again, it's a discount retailer, so you're probably going to high-end Target, or maybe, you know, if you're not that well off, you're going to Walmart, but you're probably avoiding Family Dollar when things are going well, and that's why their returns are negative during those times. During a recession, though, a lot of people go to Family Dollar. During a normal economy, a lot of people go to Family Dollar, and so it does well during those two types of economies, but poorly during a boom economy. And the point of telling you that is the idea that stocks only do well during booms, economic booms, isn't necessarily true. It depends on what you're investing in. During a recession for Family Dollar, you're going to do pretty well. Okay? During a normal economy with Family Dollar, at least in the past, I should say, you would have done fairly well. But during a boom, you would have lost money. So one measure of risk, the risk-return relationship, is the coefficient of variation. It's calculated as the standard deviation divided by the expected return. We can calculate these for both Tiffany and Family Dollar. Would most investors like to minimize or maximize the coefficient of variation? So rational risk-averse investors want to minimize the coefficient of variation. Because it provides the best risk-return trade-off when it's minimized. Okay, whenever it's the lowest. Typically what we would do then, the way we would use the coefficient of variation is if we're comparing different stocks for the same time period or different investments for the same time period, we can calculate the coefficient of variation. What doesn't work is to calculate the coefficient of variation for the same investment over different time periods or different investments over different time periods. There's better measures to use for that. One is the Sharpe ratio, which takes into account the risk-free rate and changes to the risk-free rate over time. But for what we want to do in here, the coefficient of variation works very well. What I want you to understand is that there's a risk-return trade-off, and so a lot of investors would choose the investment that gives them the lower coefficient of variation, even though it may not give them the highest return. So what are the coefficients? The coefficients of variation, it should be coefficients of variation for Tiffany and Family Dollar. For Tiffany, or TIFF, it would be equal to the standard deviation, 0.3562, up here, 0.3562 divided by the expected return of 0.2666, or 1.34. For Family Dollar, or FDO, it's equal to 0.1011 divided by 0.2207, or 0.46. So for a rational risk-averse investor, Family Dollar would be the preferred choice. Now, some people might want Tiffany because of the higher expected return, but that comes with a much higher standard deviation or much more volatility with those stock prices than does Family Dollar. So now we're going to talk a little bit about diversification. What diversification means is that we're combining two or more investments to reduce the unsystematic or the firm-specific risk of an investment. So in this case, what we're going to do is we're going to take those two investments we just looked at, Family Dollar and Tiffany, we're going to combine those into a portfolio, and we're going to see how things turn out. So the one thing that usually catches people off guard with this isn't the calculations here, but it's actually creating the portfolios. So what we're going to do to create the portfolios is we're going to say we're going to put 70% of our investment into Family Dollar and 30% into Tiffany. And what we need to do then is to calculate the rate of return. So these numbers here that I gave you before, we're going to calculate these for Family Dollar and for Tiffany based on the weights and the values of those for each of the stocks for each state of the economy. So remember, I'm putting 70% into Family Dollar and 30% into Tiffany. So I'm going to look here and I'm going to calculate what that return would be, or the expected return would be, for our new portfolio for each state of the economy. So I'm putting 30% in Tiffany. I'm putting 30% in Tiffany. So in a recession, that's going to be 0.3, the weight, multiplied by the return in that state of the economy, negative 0.2852, plus, I'm putting 70% into Family Dollar, 0.7 is my weight there, multiplied by 0.2077. So my return, my expected return for my new portfolio, if there's a recession, is 5.98%. So remember, 70% in Family Dollar, 30% in Tiffany. I'm going to do it again for the normal economy. I'm putting 30% in Tiffany, so I'm going to take the weight, 0.3, multiplied by the expected return during that state of the economy, 22.81%, plus the weight in Family Dollar of 70, multiplied by 0.2737. And so my expected return during a normal economy for my new portfolio is 26%. And then finally, during the boom, this is where we had the big return for Tiffany and the low return for Family Dollar. My weight again in Tiffany is 30% multiplied by 0.9979. Oops, left out a 9 there. There we go. 0.3 multiplied by 0.9979. So I'm putting 30% of my money in Tiffany, 70% in Family Dollar, plus 0.7 multiplied by negative 0.0138. Gives me an expected return of 28.97% during that state of the economy. So if that was confusing, please come and ask me about it. I'm happy to go through and work another problem with you on that. But that's how you create the expected returns for a portfolio of two stocks. So everything else is the same as what we did before. So let's go ahead and go run through this. So we're going to multiply the state of the economy by the rate of return for our new portfolio if that state occurs. So I'm going to take 0.15 multiplied by 0.0598 to get 0.00897. I'm going to take 0.7 multiplied by 26% to get 0.182. And then finally, I'm going to take 15%, 0.15, multiplied by 0.2897. Oops, sorry about that. 2897 to get a return of 0.043455 or 0.0435. All right, so now what we're going to do is calculate. Oh, I got to add these up. So 0.00897 plus 0.182 plus 0.0435 gives me an expected return of 23.45%. 0.2345. And you'll notice I'm rounding a little bit here. I'm rounding out to 4 spaces. I find that works pretty well. Normally what I would do is calculate this in Excel. It's a little more exacting, but for our purposes this works fine. I'm going to calculate the deviation from expected return just like I did before, and I do that by taking the rate of return minus the expected return and getting that deviation. So it's 23.45% here. So I'm going to take 0.0598, this number here, minus this number, and that's what I'm showing up here, the value in column 2 minus the expected return. Gives me a value of negative 0.1747. I'm going to square that to get 0.0305. So here's, sorry, the full view of my calculator there. And then I'm going to multiply that by the probability of 15% that comes from right here. To give me a value of 0.0046. I'm going to do the same thing here. I'm going to take 0.26 minus 0.2345, which gives me a value of 0.0255. I'm going to square that. So I square my deviation to get a really small number of 0.0007. Or 0.0006525. We'll just round that up to 0.0007. And then finally, I'm going to take 0.2897 minus 0.2345. So my 28.97% return minus my 23.45% return to get 0.0552. I'm going to square that to get 0.0030, and I'm going to multiply that. I didn't do that up here. I need to go back and do that. I'm going to multiply this by 0.0030 multiplied by 0.15 gives me a value of 0.0005, or on here 0.00045. And then I'm going to go back because I missed this to take 0.0007 multiplied by 0.7 to get 0.0005 again. So I'm going to add all these up. That's going to be my variance. 0.0046 plus 0.0005 plus 0.0005 gives me a value of 0.0056. Then I'm going to take the square root of my variance. .0056 to give me my return of, or my standard deviation of 7.48%. All right. So a couple things I want to show you here is if we multiplied our expected return for Tiffany by the weight in the portfolio, here, and the expected return of a Family Dollar by the weight in the portfolio, we actually get this number. So the weight of Tiffany in the portfolio is 0.3. So I take 0.3 multiplied by 0.2666 plus 0.7 multiplied by 22.07%, 0.2207. Sorry about that. 0.2207 gives me a value of 23.45%. That's what we get here. Okay, so the expected return for a portfolio of 2 stocks is the weighted average of the returns for the individual stocks. However, if we take the weighted average of these two, we're not going to get 7.48%. So I'm just to demonstrate again, my weight in Tiffany is 0.3 multiplied by 0.3562 plus 0.7 multiplied by 0.1011 gives me a value of 17.76%. And what I get in my calculation is 7.48. That is not a mistake. That happens because we're combining 2 stocks that are very different, that have different outcomes in different states of the economy. And by doing that, we're diversifying these stocks to make the outcome of our portfolio less extreme. So I mentioned the range before. Here the range is about 130%. Here the range is about 29%. Here the range in outcomes from our highest to our lowest is 29, actually, so it'd be 29% minus 6 or 23%. So this has a smaller range than any of the two, either of the two options we're putting into it. And so as a result of having that smaller range, it also has a smaller standard deviation. So for a rational risk-averse investor, they would prefer this portfolio if the returns occur as we expect them to over either of the two individual stocks. The coefficient of variation for this portfolio is going to be equal to the standard deviation 0.0748 divided by the return of 0.2345 or 0.31 or 0.32 essentially, which is smaller than the coefficient of variation for either of our two individual stocks. So overall, a rational risk-averse investor will prefer this portfolio of either of the two stocks that make it up. So take a little breath. Now we're going to go into a slightly different topic, but we're still talking about that same idea of diversification. So we're going to talk about systematic and unsystematic risk. Systematic risk is also known as market risks. These are risks that affect most firms. And so what risks affect most firms? Fuel prices. The risk of fuel prices increasing. Increasing fuel prices generally reduces profits for firms because for most firms, they're either shipping something, okay, they're paying for shipping, getting things shipped, they're moving something, or their customers are paying gas prices. So if you think of Walmart moves all these great big trucks around. As fuel prices go up, their costs increase, and a lot of Walmart's customers are very price sensitive. They have limited budgets. The more money they have to pay for gas to get to and from work and to and from Walmart, the less they actually have to spend on things in Walmart. So increasing fuel prices is generally a negative thing for profitability for most companies, except for oil companies. Oil companies' stock prices go up in the same manner that fuel prices do. Now, several years ago, and I can't say that it's still true, but prior to the financial crash, about 2006, 2007, gas prices were going up really high. And so I was interested, and I checked to see if I could hedge my fuel price risk by buying stock at Exxon. And what I did is I found the data for the weekly change in price for for fuel in my area where I lived in Wisconsin, and I calculated the correlation between the percentage change, weekly change in gas prices to the percentage change weekly change in Exxon's stock price, and I found that the correlation was 80%. And in other words, they move together fairly closely. So if you think gas prices are going to go up, a good investment might be oil stocks. Okay. But for most other companies, it is a increasing fuel prices hurts their profitability. Other things, inflation. That's a market risk for most firms. It affects most firms. Interest expense affects most firms. Unemployment affects most firms. And unemployment can be a positive for a firm or it could be a negative. So high unemployment reduces labor prices because there's a great big supply of people that want jobs, and so because the supply is outpacing the demand, the price of the good or the service, in this case labor, goes down. On the other hand, if people are unemployed, they don't have money to spend, and so they can't go to the store, go to Walmart, or go to the movies and pay as much or buy as much as they normally would. So these are examples, and I apologize, I should have put them down here. These are examples of systematic or market risks. Okay? These are risks that most firms face, and their stock prices will be affected by these risks. Unsystematic risks are firm-specific or asset-specific risks. We generally refer to them as firm-specific risks or unsystematic. These are risks that affect specific firms or firms within a single industry. So some examples of unsystematic risks. These are generally have to do with the product or service that they provide. So product liability, product obsolescence, those are both things that a lot of firms face if they sell a product and it's dangerous or there's something wrong with it and they can get sued. Not only they get sued, but also it hurts their ability to sell in the future. You know, a recent example of this is the Boeing company with their planes, the 737 MAX, I think it's called. Having some problems, that's going to really affect, and it did affect the stock price of Boeing considerably. It's going to affect their reputation going forward too. Then we have product obsolescence, products that firms sell that people just don't want anymore. These happen. Flip phones might be an example of this. They were really big prior to the smartphone. You can still buy a flip phone, but they're fairly obsolete. So some examples of firm-specific or unsystematic risk are product liability, product obsolescence, managerial malfeasance, and I think I spelled that right. I don't have a spell check on my pen here. In other words, managers doing bad things. And one more example of this is regulations. I like to throw this one in here because sometimes people think of that as a systematic risk, government and regulations, but really regulations are generally written to affect specific industries, hopefully not specific firms, but specific industries, and so they don't affect other industries as much other firms in other industries as much. One thing to point out about this that I want you to know is that these affect either specific firms or firms within a single industry. So when Boeing has problems with their products, Airbus, another company that builds large airplanes, tends to do a little bit better. Their stock price, Boeing stock price, goes down. Airbus's business does well, because the people that were considering buying Boeing jets that will now not do that because of the product issues still want to buy a jet, or they want to buy a plane. They're going to look over at Airbus as an option for that. Managers get caught doing bad things. They get in trouble. A good example of this in the last few years is Wells Fargo, when the management and the company itself were encouraging employees to create fake accounts for their existing customers and to sell products to customers without letting them know. Certainly managerial malfeasance, certainly hurt Wells Fargo stock, but benefited other financial services firms because now people that won't go to Wells Fargo still need a bank, and so they're going to go to other banks. So an investment's level of sensitivity to market risks is indicated by its beta, and this is the Greek letter beta, capital beta, which is the coefficient from a regression of the investment's returns on the returns for the market. In your business statistics class, you should, I believe you did cover regressions. I'm not going to have you do that in here, but it is good to understand what that is. The way that we calculate this coefficient is through a time series regression of the returns for the individual firm on the returns for the market. And so what we get from that regression is that we get the beta, and we also get an alpha or an intercept. Just a little side note, the alpha down here is the excess monthly return for investment I that is not explained by the return on the market, meaning that this is an excess return not explained by market risk. There's a well-known website for investors called Seeking Alpha. And this is what they're talking about. They're looking, what that means is these are investors that are looking for excess return not explained by market risk. So they're looking for investments that provide a higher return than what is required by the risk of the market. So RIT is the return on the investment for month T. Alpha is the excess monthly return for the investment that is not explained by the market. R sub MT is the return on the market for month T, and we usually use for this, or I use, and I see most people do this, the return on the S&P 500. And I mentioned what that was before. It is an index of the 500 largest market capitalization firms in the United States. And then the epsilon here is the amount of the return for the stock T that is not predicted by the model. And a lot of times we would refer to this as the error term. So that beta is pretty important. And if you ever want to draw it out, it's just like a bee with a little tail there. Or some people might do it like this. It's probably more appropriate. Forget that. B, or we just refer to as beta. A stock with average market risk has a beta of 1. That regression coefficient is 1, which just means that it moves with the market. A stock with less than average risk has a beta of less than 1. A stock with more than average risk has a beta of greater than 1. Can beta be negative? Theoretically, yes, but it's rare. What this would mean is that investment moves opposite to some degree to the market overall. So we saw before Family Dollar had a low return, and I've got one in here that isn't Family Dollar because there's some things, at the time I was doing this, there were some things going on with Family Dollar. It made it hard to get some of the beta for the firm. But Dollar General is a very close company to Family Dollar. You can see here that the beta for Family Dollar is very low. Or excuse me, not Family Dollar. Dollar General is very low. And we'd expect that because, like I said before, it's somewhere between counter-cyclical and a non-cyclical company. So it has a low beta. It doesn't move much with the market. So what else is produces a negative beta? Sometimes gold. especially during the last financial crisis. The value of gold went up to about $1,800 per ounce at the same time, which is a record high. At the same time, the stock market was bottoming out, so the returns for the market were going down, the returns for gold were going up, and at that time we got a negative beta. Now, it wasn't -1, but it was, it was a little bit negative. So in general, it didn't move with the market, but kind of a little bit opposite of the market. But so that can happen, but it's rare. So here's the betas of different stocks. I already mentioned Dollar General. Tiffany when I checked this, had a beta of 1.82. So almost double the riskiness or the market risk of the average stock. Apple actually has a beta of less than 1, which was a little surprising to me because I think of that as a luxury good, but so many people own iPhones or MacBooks or some kind of Apple device that they are engaged with the Apple ecosphere. They use the Apple services and they're locked in that way. So they're less likely to move to a different product. Even if the economy goes into a recession, they break their phone, they need a new phone. If they can, they're going to buy an iPhone because they're already in that ecosphere. They're already locked into that. So Apple has less than average market risk. Gold, I mentioned gold, that sometimes have a negative beta, very low beta. In this case, 0.22. So it does not related much to the market. General Electric is a conglomerate company. They own many things. They do many things. They make appliances. They make airplane engines. They make light bulbs. They used to own, not anymore, they used to own NBC, cable company. It was, prior to a couple of years ago, the largest business that General Electric engaged in was finance through their GE Money Bank. They issued or they funded a lot of store credit cards. So if you have a credit card that's store branded like Kohl's or JCPenney, or I apologize if you have this, a Sears credit card, a lot of those types of cards were actually funded through General Electric Money Bank. They got out of that business a few years ago, but in general, a conglomerate company, a diversified company here. And then Bank of America, a very large bank, also has a very high beta, and that makes sense. Bank of America does well when the economy does well because they lend out money, and they make a lot of their money by lending it out. Whenever the economy is doing well, people borrow more money to engage in business and to increase the size of their company because people are buying their goods. When the economy is doing poorly, the opposite occurs. Financial services industries are also sensitive to interest rates changing. And so certainly that would also impact Bank of America's beta there. So that gives you an idea of why different companies have different betas. It's based on what they do. So the beta of a portfolio is the weighted average of the betas of the investments in the portfolio. So if we created a portfolio that's 30% invested in Tiffany and 70% invested in gold, the beta of that portfolio would be equal to 0.3 multiplied by 1.82, the beta for Tiffany, plus 0.7 multiplied by 0.22, the beta for gold, and that would give us 0.3 multiplied by 1.82 plus 0.7 multiplied by 0.22, a beta of 0.7 for our portfolio. What I want you to know about this, I want you to recognize about this, is that when we looked at the portfolio of Family Dollar and Tiffany, combining the two investments lowered the riskiness of the portfolio. When we're looking at beta, because beta only looks at the market risk of the firm, combining investments together to create new portfolios doesn't reduce the overall risk. because in this case it's just the weighted average of the two risks. By combining two different investments based on the standard deviation, the overall standard deviation declined, below either of the standard deviations of the two different investments. So because beta doesn't consider firm-specific risk, combining firms with different betas together only gives us the weighted average of those betas. There's no diversification benefit there. And the reason why there's not is that the capital asset pricing model, which this is based on, which the beta is based on, assumes already that investors diversify, and so there shouldn't be any firm-specific risk in your portfolio. And that's what I've got down here. Diversification can eliminate the unsystematic risk. So remember, firm-specific, sorry about that, firm-specific, there we go, that's a specific risk from the portfolio. In the mid-1960s, Traynor, Sharp, Lintner, and Mosen, four different researchers, economists, independently developed the capital asset pricing model, or CAPM. The basic premise of the model is that since unsystematic risk can be diversified away, rational investors will hold diversified portfolios to eliminate unnecessary risk. As a result, only systematic risk should be rewarded. So in other words, the only risk that should affect returns is beta, is the market risk. So only the market risk of the firm, the investment's sensitivity to market risk should impact the return that investment provides. Based on this idea, the CAPM says that the returns for all assets can be calculated based on their sensitivity to market risk using the security market line. Sometimes you'll see this as SML, security market line. The security market line is calculated as the expected return for an investment is equal to the risk-free rate plus the risk premium for the market multiplied by the beta of the investment. And the idea here, according to those researchers, is that any asset that you can invest money in, not just stocks, but any asset, you can determine the expected return for if you have the risk-free rate, if you have the beta of the investment, and if you have the market risk premium. So what is the market risk premium? The market risk premium is the excess return that investors expect to receive for investing in the average stock above, and so excess return above the risk-free rate. And then we're going to work some examples of this below, but one way to think about this is that if the risk-free rate is equal to 3%, okay, so this might be the yield on a 10-year U.S. Treasury is 3%, and the expected return for the S&P 500 is 8%, then the market risk premium is equal to 8% minus 3% or 5%. The market risk premium generally ranges between 3% and 7%. It can go outside of that range, but it's kind of rare. So RP sub M is the market risk premium, ranges between 3% and 7%. All right, it ranges between 3% and 7%. When the economy is doing very well, when people are happy, when things are looking good, people don't need as much return to invest in the market above what they would need to invest in the risk-free asset, a U.S. government treasury. And so the market risk premium is lower when times are good and people expect good things to happen, and it's higher when things aren't so well. When people are frightened, they pull out of the stock market because they would require a higher return in that stock market because their risk aversion is higher. That increases the risk premium for the market. Right now, I just checked it the other day, the market risk premium, there's someone named Aswath Damodaran. I'll write his name on here. He has a great website if you want to check out, oh, sorry, it didn't spell it right. If you just go to Google and type in Damodaran, his name is Aswath Damodaran. He has an excellent website on corporate finance and markets. He puts out a lot of different spreadsheets that help calculate things. He calculates this, actually 3 or 4 different estimates of this every month. The estimate I generally use is one of the cash flow estimates, and right now it's about 5.4%. Okay, so the market risk premium, according to this guy, the one that I use, like I said, he produces different ones, is about 5.4%. And if you're interested in that information and those types of things, I would definitely check out his website. He's got a lot of good information there. So the security market line, remember the security market line is this. The expected return is equal to the risk-free rate plus the market risk premium multiplied by the beta. We can draw it. So take a second and think back to middle school. And if you remember, you might have learned something called the slope-intercept form. So the slope-intercept form said that y is equal to mx plus b, y being the variable you're looking at, m being the slope, x being the x value on the horizontal axis, and b being the y-intercept. B being the y-intercept. So I don't have great drawing skills, but we can actually draw out the security market line if we have the values here, because the B, the y-intercept, is our risk-free rate. Our slope is the market risk premium. And our beta, I'll put it over here, but our x value is the beta. Okay. So our beta goes on the y-axis, our return, our expected return, goes on the beta goes on the x-axis, the expected return goes on the y-axis. Our intercept is the risk-free rate. And so for any value of beta, we can draw a line and determine what the value is, the expected return is. So I give you an example down here. The risk-free rate is 2.9%. The market risk premium is 5.4%. For the average stock with a beta of 1, the expected return would be equal to 0.029 plus 1, the beta multiplied by 0.054, giving us an expected return of 0.029 plus 0.054. I'm leaving out the 1 here because 1 multiplied by 0.054 is just 0.054. So I get an expected return of 8.3%. So our line would look like this. Our y-intercept would be here, a little bit below 3%. And then we go up here and say that's 8%. So our expected return with a beta of 1 would be 8.3%, and we can just draw a straight line there. Again, I'm not the best artist. That should be a straight line. And so we would have a risk-free rate of 2.9%, and based on the line here, again, remember the slope is equal to the market risk premium of 5.4%, and the expected return for the market, because there's a beta of 1, would be 8.3%. So let's calculate. We don't need to draw lines for these. We can just calculate the expected returns using the capital asset pricing model to determine the outcome. So again, our risk-free rate is 2.9%. The market risk premium is 5.4%, and we can calculate. Then we just need to plug in the betas to get our returns. So for Tiffany, again, we're going to take 0.029%. That's our risk-free rate, plus 1.82 is our beta, multiplied by 0.054 is our market risk premium, gives us a value of 0.1273. So our expected return for Tiffany, based on its beta, is 12.73%. For Dollar General, 0.31, excuse me, it's not right, 0.029 plus 0.31 multiplied by 0.054 gives us a value of 4.57%. 0.0457. Apple, 0.029 plus 0.83, that's right, multiplied by 0.054 gives us an expected return of 7.38%. Gold is going to give us a low return because they have a low beta. So 0.029 plus 0.22 times 0.054 has an expected return of 4.01%. Oh, sorry. Not 4.01, 4.09%. General Electric has a beta of 1.28, so we take 0.029 plus 1.28 multiplied by 0.054, or 9.81%. And then finally, Bank of America. It's going to be close. It's going to actually be a little bit higher than Tiffany because it has a little bit higher of a beta. So we're going to take 0.029 plus 1.84 multiplied by 0.054 to get 12.84%. So these are the expected returns for the stocks, these individual stocks, based on the risk-free rate, which currently this is very close to the risk-free rate. It changes daily, but I looked it up when I put these notes out. And this is the market risk premium of 5.4%, which means that we would expect the average stock in the market to have a return of 8.3%, which is a little bit lower than the average return on the market. The average return on the S&P 500 is usually around 11 to 12%, but it varies greatly year to year. So these would be the returns for the expected returns based on the CAPM. So this is the end of these notes, but I want to make a note here. talking a little bit about this model and what it means. In finance, we use this model a lot. If you move on in finance to other classes, investments, intermediate finance, you're going to see this model again. We use it because it's useful. What we know about it, and it's useful because we can adjust the capital structure of the firm and very easily see what happens to these values. Not something we're getting in this class, but it's something that we can certainly do. However, its usefulness is limited because what research has found is that it's not that good at actually predicting the returns for firms, and that's because it does ignore those firm-specific risks. There's several methods that use this idea and use the capital asset pricing model to get a better estimate. I'll give you a couple of those. One is the Fama-French three-factor model. So in the early 1990s, Eugene Fama and Kenneth French tested the capital asset pricing model. They tested this model here. They went back for several years, several decades, and tried to see if the beta of the firm could predict the returns, and they found that it didn't. And they wrote a really big research paper on this. It's been published in the top journals. And they contacted Sharpe. I had it, up here. That was one of the names who won the Nobel Prize for this model. They sent him all of their research, and they said, "What did we do wrong?" Sharpe responded back and said, "You didn't do anything wrong. The model's never worked." Okay, so I'm teaching you this model that theoretically never worked, but it is useful for a couple of reasons. I mentioned one of them. It's used in their three-factor model. They add two additional factors of size and value for firms, and they find that it does a much better job. That the market risk, the sensitivity to the market risk, is an important factor in determining the required return, but it's not the only factor. Another model is called the arbitrage pricing theory, or APT. And the idea of the APT is that the only risk that matter is the market risk. So it's based on this idea that investors can diversify their investments and eliminate firm-specific risk, but they said not all risk or market risk are equal for all firms. So, for example, Ford Motor Company might have a higher sensitivity to fuel prices than, say, Amazon or Tesla or another company. And so what they do is they individually categorize different market risks and determine the individual betas for individual risk, and they find that does a better job as well. So this is something that is used by companies. Many years ago, I visited Walmart headquarters. I met with the people that determined the required rate of return for them, and at that time, hopefully it's changed, but at that time, this is what they used. They used the calculation of beta for Walmart and the capital asset pricing model and the security market line to determine the rate of return for the required rate of return for Walmart stock. So this is it for these notes. I'm going to put out some quizzes online to cover these as well, and I hope you have a good week.